If you have been watching the headlines, you must be noticing that interest rates are shifting, rents are hitting new records, and banks are upgrading their forecast about property. You must be wondering, is property still a safe investment heading into 2026? Or are we walking into the hidden risk no one is talking about? I'm Hitesh Sharma from Atholant Wealth, and today I'm breaking this down with real data, simple explanation, and 3 things investors absolutely must get right in 2026. But before we decide whether the property is safe or risky, let's look at what's happening in the market. Most major research houses like CoreLogic, Domain, PropTrack, they all reported price growth of 4 to 6% in 2025. Now let's talk about 2026. The forecast sit between 5 to 7%. If we come back to our big banks, their forecasts are even sharper. Westpac are saying up to 9% growth, NAB around 6%. Meanwhile, rents, especially for units, jumped 7 to 10% across many capitals. Even with high interest rates, property kept growing and rental yields strengthened. But the reason behind that growth is what matters the most. Why is property still performing when rates are high? Now it comes down to one thing. Demand is exploding, but supply is not. Do you know Australia added over 600,000 new residents in 2024? And yet we're still not building enough homes for them. That imbalance shows up as vacancy rates under 1%, severe tenant competition, faster than expected price recovery after the RBA easing cycle in 2025. Now when you combine the population growth, low supply, and you add strong rental demand to that, you get scarcity. And always remember, scarcity protects the long-term win. The market is holding up, but there are real risks which you cannot ignore. Interest rates are still around 5 to 6%. Now this puts pressure on cash flow, especially on the negative geared property. Affordability is at 20-year low, and that's according to CoreLogic. Some buyer segments may slow down in 2026, and if the RBA delays the further rate cuts, borrowing power will continue to stay high. So the question is not should I invest, it's how do I invest safely in this environment? The 3 moves we'll talk about today. Move 1, prioritize your cash flow. In a high rate environment, the weak cash flow gets punished, and this is the year to look at the units, townhouses, or dual income setups in suburbs with strong rental pressure. Move 2, go where the supply is tight. Cities like Perth, Brisbane, Adelaide continue to outperform because listings are extremely low. Tight supply equal to resilience. Always remember. Now move 3, follow data, not the headlines or hype. Media headlines create fear. You have to make good investment decisions. You need to follow population trends, infrastructure pipeline, rental demand heat map, and these indicators reveal future growth far more clearly. Property remains one of the strongest long-term wealth builders, but in 2026, it's the strategy that matters. Now at Atholant Wealth, we help investors interpret the data clearly. We avoid common traps. We build portfolios designed to last through every market cycle. Now, if you would like clarity around your next move, you can book a consultation on our website. I'm Hitesh. Thanks a lot for watching this video. I'll see you next time.